Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is Friday. Yesterday was quite the day again, like crazy. I don't think that we did too good of a job picking up on what the news that was going on at the time. We were on the right side, but holy crap, it went like 4 times further than it did after the stream ended. Pretty crazy stuff, right? But basically, the banks put together an organized bailout of one of these failing banks, and so you know that all of those banks, they know that as soon as that news gets released to unleash the buying, and that's what happened yesterday. So with all of that said, we've got a pretty big options expiration coming up today. It's not going to be the end all be all of everything because we got a Federal Reserve meeting next week, and so there's still going to be a lot of options out there for next week as well, right? But what that means today, if we come to the charts, what that means for us today is that you're going to have an extremely hard time staying above 4,000. So I'm just seeing here live action saying an ES short looks good here, etc. I mean, if I was trading the overnight, I would have just had my limit sell set right at 4,000. I think we are extremely unlikely to close above that today. Who knows? Maybe they get pinned to that and we just close it exactly at 4,000. But I don't know. The crazy thing is when you come back and look at things on like a daily chart, okay, it's not that bad actually. Like from 4,200 to 3,900, I guess at one point. It wasn't that bad. But anyways, here you can see in the treasuries though, they really came back. It looks like we're kind of seeing some rise here again. Oil, gold and silver still looking pretty okay. Silver not breaking up, gold did. Copper recovering. So, and here's Bitcoin. Actually breaking that more recent high is just pump over there, man. I'm really scared of Bitcoin right now. Like that thing has this ability to just completely, like the floor just completely fall out from underneath you. But it looks like they're in pump mode, so it's kind of one of those things that you probably make money, but like it's more likely to go up. But then, you know, when the regulators hit, it's going to be crazy. Okay, so this morning, there was Canadian PPI and everything, lean umbrella, but we don't really have a whole lot going on this morning, so it's really is like going to be a more quiet session where we can run the options are kind of be more dominant, right? But like here's the thing. Okay, so the reason we moved up yesterday as aggressively as we did was because the banks organized the $30 billion bailout of this bank, right? I knew that I had read the headlines that this bank was going under and this and that sort of thing, but I had no indication that like it was a really dire situation and that they absolutely, that the market was going down because of that. Now, I was still watching Credit Suisse, right? And that's kind of the thing that's kind of crazy is that it's all like under the radar bank stuff, and then the headline hits, and after the fact it goes up, and like that's nobody in the regular world, only people in the banking world know what's going on, right? And I haven't been as informed about this as I would like to be. But the question is it over? Like, it's a big injection. Is it over? Is the whole thing over? And I'm leaning towards no. I'm leaning towards no because have we actually solved any of the problems? Look, Federal Reserve is going to raise 25 basis points next week. I'm betting on it, them being 25 basis points. I don't see how you can come in and inject like $2 trillion into the economy that quickly, you know, and not be inflationary in some form or another, right? And since we were already kind of having problems with inflation, of course, like some of these things like our manufacturing numbers have all been really bad. But, you know, what are you going to do when April comes around and you get April and May numbers and services sector is still doing really well, right? That's going to be a real problem. So, and the whole thing here is that like you bailed out one bank, but this is like a industry-wide problem. Like, look at how many people, how much money was actually taken up by this new BTFP program, right? It was like every bank that qualified did it. It probably every bank that qualified for that thing did it, based on how much money it actually got used by the Fed there, right? So they're all like terrified of bank runs, right? But like, here's the thing. What's going to stop it? Because when you look at everything that they did, what would be your takeaway as a business owner? I'll tell you what your takeaway as a business owner probably should be, is that you can't have, if you have more than $250,000, you can't keep it at a regional bank, that you need to go and to put it into one of the quote unquote systemically important banks, right? Because you just see this thing the other day that Janet Yellen was saying, well, we can't bail out everybody. So who are you going to bail out? Well, only if it's like we have to bail them out or the economy plummets, right? So your small local bank in your city, they're not systemically important. You're not going to get the bailout. That's basically what they said. So who in their right mind would put their money there? And it already happened, like everybody put their money into JP Morgan. And then what JP Morgan is doing is sending the loans to these smaller banks. So you didn't actually, like, you just did triage. You didn't actually fix anything, right? So I foresee this being a thing that like maybe just continually comes up over and over again. You know what I mean? Like, kind of just like this week, but over a longer time frame, right? It's like they save one bank and then there's a big rally, right? And then overnight there's another bank that has a problem and there's a rally. I don't think you're going to continue to see institutions and so forth go under and create short-term shocks that the market does its best to try and like look past. What a glorious catch-22. Print money to save the banks from your interest rates and cause more inflation, or raise rates more to fight inflation and cause more bank failures. Yeah. Like, you're between a rock and a hard place. Oh, like here's the thing. Here's a problem that I think that they need to solve first, before any of this other stuff, is why should I put my money in a regional bank, right? Like there needs to be something about the way that a regional bank works that provides me an advantage as a local to use them, right? And I need to have the confidence that if I put my money in there, that bank is going to be safe, right? So this kind of comes back to those regulations that Congress is saying, well, the reason that we had this problem was because you reduced or you increased the amount of assets under management that you had until you started to qualify under all of these systemically important rules, and then you had stricter capital requirements. They said, no, the smaller banks don't need to go along with those, and they claim that that's why Silicon Valley Bank went under. But the reality is that if Silicon Valley Bank was treated as a systemically important organization, we would have just come to this point earlier. And then people take their funds out and you still have the same problem, right? That doesn't solve the problem. You have to solve the confidence in regional banks, essentially, right? So if you solve that problem, now you can come to a spot where you can raise interest rates, and yeah, some institutions that where the worst performing ones will go under, and you can allow them to go under without it, you know, completely destroying the economy and harming citizens and taking millions. Now, is a way to do that to backstop all deposits? I'm not sure they can do that. I'm not sure they have the money to do that, and that would be possibly inflationary too. So, like, I don't know what you do, but man. Funds and broker accounts aren't, no, they're not. I tell you what, man, the one that has been the most striking to me, the one that I'm like, what, was Charles Schwab. They said that people pulled some like $2 or $3 billion out of Charles Schwab for no real reason. Like, I mean, I guess they protest too much, right? And that's kind of the funny thing, is everybody gets into this mode of, well, if they're talking about it, it must be a problem, and then I need to take my money out. Way to go. So now this is another problem that I don't know how you deal with, because now it's like, you can't say, if something's wrong, you can't say anything. And if everything's fine, you can't say anything, because if you say anything, it's interpreted as negative and people pull their money out. So how can you expect any financial institution to be responsible and tell the public what's going on? You all pull your money out at the first sign of trouble, regardless of whether or not there actually is trouble. Like, that's a real problem. Right? So in all 2 or 3 of the things that we've talked here about so far, right? It's like you lose either way. So how can I have confidence buying the S&P 500 right now? You know, and that's kind of what it comes down to, is that I just don't see how markets can get above 4,000 right now. Or yeah, 4,000. I see them having a very hard time keeping a bid above 4,000. Okay, now one other thing, actually maybe 2 other things we want to talk about. Yesterday there was a major analyst. Sorry, I forget which research. I was like Alameda. No, not Alameda. Those were the guys that went kaput. I forget which research outfit it was, but this was a researcher that is quite well respected in the semiconductor space, and he upgraded this semiconductor space. He took Intel off of the sell list and to neutral. So Intel was up like 6%. It was the biggest winner on my watch list yesterday, at least. I was like, oh man, maybe yesterday was the day that I should have bought Intel. But so that's probably why the NASDAQ did so comparatively well yesterday. Because like my banks, for instance, they were still kind of like meh. It was still kind of meh. Right. Okay. Now, the other thing I wanted to ask you guys is, would you guys like to do a, sorry, what do we call this? A stage? A live stream / stage in Discord today? Because to be honest with you, I was feeling pretty burnt out yesterday. I think part of it was I argued with somebody on Reddit that was particularly exhausting. Oh my gosh. They were like, oh, price action definitely does work. I'm making millions of dollars from it. And I'm like, okay, but do you have any empirical evidence of that? And after them going back and forth and getting extremely angry because I wasn't validating their personality as a rich person, they admitted that they did not have any empirical evidence, and that was the end of it. But so I'm feeling tired, and I would like to hear more from you guys. So what we can do is we can go into Discord and we can start the thing, and then you can raise your hand, and then you would have the opportunity to talk. We can even talk about the Ukraine thing if you really want. Top analyst called for 42.50 ES target if the interest rates are 3.5. Or are they saying like if interest rates in general were 3.5 or if the 10-year was at 3.5? I don't know. I mean, we're still at like what, 3.45? Yeah. We're still pretty close to where we were at yesterday, actually. On the 10-year. Yeah, well, if this ends up being like a massive deflationary impulse into the economy that causes the Federal Reserve to like back off or even start decreasing rates, that may be true. Right. Because once you bring those interest rates down, then you can justify higher valuations for equities. Right now, it's getting harder. So this is really interesting. If you've never read All In, or sorry, there's a podcast called All In you can listen to. It's got like Chamath and his buddies. Okay. But Chamath talks a lot about how the change in interest rate changes the valuations that venture capital funds and so forth need to bring in order to justify the investment. So like he was saying that when you factor in costs and all of these other things, that in order to justify an investment, like in order for them to say it's better for me to invest my money in the venture capital or a startup, let's say, in order for me to justify investing in a startup versus like just buying bonds, they need to be making like 25%. It's like the amount is like really crazy because not very many, only like the most golden of startups accomplish that, right? But bank issues through, well, and that's the thing is that I'm not sure. I don't think we really know. You know what I mean? I don't think we really know how bad it is or has gotten. When you look at the market yesterday, you know, and if you were to just believe the market, okay, and of course we know that markets are not perfectly efficient, and how could they be efficient in this situation when we really just don't know what's all going on under the covers? There's just no way for us to collect all of that data right now, right? So what is the real actual economic situation underneath of the covers? I don't know. I'm just telling you, I'm really concerned that this didn't actually do very much damage. And if this didn't actually do very much damage, but they created like $2 trillion, that's a big problem. Right? Okay, so how I got to remember how we do this. Start at the stage. Sorry, it's getting that sound in the background because of me starting it in Discord. So I will start the stage in Discord. Nobody said anything, so I think that means that you guys don't actually want to do it. But I'm gonna start the stage in Discord. If you've never joined our Discord, just go find the link. And I don't know if I've got, so can you guys that are listening in Discord, can you hear me? Do I have that all set up correctly? Or do I need to make some changes in Discord? Should be fine. It says it's using the default. I actually got a lot of people joined in Discord. Let me double check something real quick here. And give it a few more minutes before I start asking people you want to raise your hand. I mean, you can raise your hand right now if you want to talk. You have something to say. That's what we're going to do today. You can play Mario Kart. Okay, that is not... They probably cannot hear me because it should be this. Okay, now people on Discord should be able to hear me. Can you hear me on Discord, guys? Pull up the chat and say, yes, you can hear me. And Steffa says he can hear. You lost your password to Discord live action? Come on, man. Okay, so what we're going to do here is we're going to make this open mic. Well, as an open mic, let's not say open mic, but you can raise your hand. So if you want to talk, you can raise your hand, and I will just start talking here. Yeah, you do have to attach your phone. So I tell you what, man. The amount of spam attempts against our server is so insane. I literally get like a dozen accounts trying to impersonate me every day. They kind of died down a little bit yesterday, but there's just so much spam. I don't know where they're coming from. If any of you guys know where they're coming from, you come across and they're like, oh yeah, here's a list of discords to go and spam, and this how you go and spam them or something. I would assume that they're not other discords, because I would hope that anybody doing that Discord trust and safety would get them and stop it, right? But oh my gosh. So we have to have really strict verification requirements because of that. All right. Okay, let's see here. So I get show requests here. There we go. Yeah, and I will allow requests from everybody, all right? So while I'm thinking about it, I want to go back a little bit to something that we were just talking about. Okay. So remember, was it like Tuesday or Wednesday? I think it was really more Tuesday that everybody was worried about Credit Suisse, right? Was it Tuesday? Everybody's worried about Credit Suisse, and then eventually the Swiss government comes in and they're like, oh, no, don't worry, we'll bail them out, right? Okay. Market recovers. It was an okay recovery, right? Treasuries sold off okay, right? Then the next day we're right back up there again. But then when this other bank from yesterday got bailed out, that one was like this absolutely massive move. Absolutely massive move. So when you watch that and you kind of, if you go with the typical way of thinking that the market is perfectly efficient, which we know is not true, but if you were to assume that the market is perfectly efficient, then you would believe that something about that bailout was more important, that bank was more important, or was more in distress, or was a bigger deal, or you know, something like that. Well, I don't think that that's what happened. I think that the reason the second one went off more was because all of the banks were involved. Like, did you go and listen? Let me pull this up here. Where is it here? First Republic, sorry. First Republic, 30 billion in First Republic. And when you pull it up here, right? Bank of America, Citigroup, JP Morgan Chase, Wells Fargo, Goldman Sachs, Morgan Stanley, BNY Mellon, PNC Bank, State Street, Truist, and US Bank all contributed together to make $30 billion, right? So, you know, I mean, I don't think that they can necessarily like leak that to their trading desks ahead of time necessarily, right? But you know that as soon as that's released, they're sending it over to their trading desks, and the trading desk doesn't ask any questions, right? They start buying right then and there. Oh, I've never heard of Truist. Let's see here. Is there any other on that list I've never heard of before? I've heard of all of those banks except for Truist. Although I am surprised like BNY Mellon and PNC Bank get on that list. I kind of wonder why. Was it that difficult to scrounge up that much money, you know? It was an underwriter for SunTrust, and then they merged. You're short ES. I'm a little disappointed because I went to bed last night thinking, okay, if it gets to 4,000, you know, we should try shorting it. I was even thinking about, like, you know, opening up the order column for ES and trading ES on Sim again, just for that one. But I kind of feel like the opportunity is already passed. Although I don't know. I kind of suspect that you're trying to say that because of price action setups, right? I'm kind of suspicious. You know why though? I'm like I'm so ultra suspicious of price action stuff, right? not of, I mean, we know that price action is not really very effective, but I'm particularly suspicious now of the people that I see out there promoting it, because here's what happened. Okay, is that there was one YouTuber. It really is. I might be overstepping here by saying that it was one guy. I think that he maybe picked it up from a couple of other different people, and they may have come up with the philosophy together. I don't know, but there's this idea out there. They call it smart money concepts. So the smart money concepts are basically price action rules, but they explain it based on the market maker is there to try and screw you over, right? Yep, it's the ICT stuff. So yesterday, I saw a video that was like game-changing strategy, 80% win rate, mentions ICP in there. Or sorry, ICT. I don't think that ICT is a good acronym for a name, right? Because it's like insane clown trader. Is that what that means? That's what I think every time I hear that name. But anyways, so like what I realized was that term has become enough of a search term that now there is this little cottage industry of YouTube creators that are making videos with ICT in the title to blow up. Like straight up, and they're getting like thousands, tens of thousands of views. It's because like the thing was I watched that one video thinking, oh, okay, maybe this will give us a strict enough price action setup that we can backtest it, right? Once I watched one video, it started sending me so many. So many of them started coming up on my feed, and some of them were really bad. The attributing motive? No, I can. So let me show you something. Yeah, it really actually stands for Inner Circle Trader, Mr. M. Yeah, Inner Circle Trader. So he used to be just. This is where it's kind of like channels can just randomly blow up. I don't know what happens or how YouTube does it, but channels, you know, it could be the case. I wouldn't even be surprised if like I decided to go off and do something else, that I couldn't do the live stream anymore, and you know, just left the YouTube channel as it is, and then it blew up on its own. It wouldn't surprise me in the least bit. YouTube is just weird like that. Okay, but let me show you something. I'll pull up that, and I'll pull up the editor here. Well, it's not just that, Uzi. It's trying to claim that there's certain price movements predict other types of price movements. That's the thing that I say is a problem, right? So you notice when I make a claim based on market microstructure, right? You got to be really careful. These are very narrow claims, right? Okay, so I would say auto-correlated order flow, that is an imbalance of market orders buying over a long period of time, okay, is an extremely effective indicator. Of all of the NinjaTrader strategies that I've ever built and backtested, auto-correlated order flow is the best performer on a risk-adjusted basis. That's based on tick replay data, so you got to be a little bit but there still was a much more edge in that than many of the other things that I've tested, right? So the theory is that the market moves according to trend line and fib. Well, so okay, first of all, let me pull up the code for this. Like, the thing was, I think part of why I felt so exhausted yesterday was because I went and I did this back test. And then when I got to the end of it and I looked at the stats, I was kind of like, I don't even know if this actually would make a good video. Like, I think I just did that for no point. That's why I'm showing it to you guys today, because then there was actually at least a point to it. Where's my thing here? Okay, so here's the way that they kind of approach it, right? Is there be a price, a level, support, and resistance. So in this particular instance, they will consider resistance being the previous day's high. Okay, I think that one is a really good example to use, just because that's where you get a price point that you can really clearly define, right? Support and resistance is not as definable as people think that it is, right? Like, can you make an indicator that accurately puts what support and resistance should be all of the time? Because the thing is that your strategies are way more vague than you realize. So I'll show you why here. Okay. So the way that their strategy works is it's coming down, right? And then they bust up here. Okay. They call this a liquidity grab. Okay. And they don't want to trade against it on the first break. Okay. Because what you find is often it will like come back to this line and go higher. That happens a lot, right? So instead, what they want to do is they want to break the structure. So they're looking for this pivot from before. Last time that price moved, they want it to break that, right? And then they want it to come back up. And the way that they determine how far it goes back up is there's going to be a candle in here that has a gap. So let me see if I can explain that. So if I come over here to the S&P 500, for instance, right? You can see that there was this bar that was pretty long, and you can see the tail of the bar before it and the tail of the bar after it, right? And then there's this huge gap in between, right? So he calls this a fair value gap, which, by the way, is like dead wrong. That it would be considered fair value. What this is that this is an area where the market orders became dominant and just really pushed through the market, right? Those can be interesting areas, because if you start retracing an area soon after the move, there could be less liquidity in that area, and so it makes it a little bit easier to sweep back through. Okay, these could be liquidity holes, although I don't think that you could really confidently identify those using just a chart. Okay, but just so you know, okay, that's how he defines a fair value area. It's not a fair value area. ICT, I can't trade. There you go. Okay, so that's how he defines a fair value area. Okay, so I actually went in here and made an indicator for it. Okay, so it's quite simple. Where is it here? Fair value gap. Okay, so here we can say so when we get to the end of this bar, because we can't know until this bar is done, right? So we get to the end of this bar and we can say the high of this bar and the low of the bar 2 bars before that, and there's a certain amount of gap. And I have a property in here for you to define how big of a gap that is, right? How big of a gap that is, okay? So their trade is once you've broken this structure, then you look for that fair value gap, and if it comes back to that fair value gap, then you take the short. So it's supposed to come up like this, and then gadoosh, 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 right? And then there's a couple of different ways that you can try and do this. But one way is to say, okay, I took the trade here. I'm going to put my stop at the high, and then I'm going to do like 2-to-1 risk reward or something like that, right? That's the strategy. Okay. So I said I don't think that people realize how much wiggle room they actually are putting in all of these strategies. They play out differently on different time frames. Yeah. So tell me this. What if, I'll draw another picture here. Here we have a high. What if it did this, and then it did this, and then it did this, and then it came back? Do you still take that one? Right? So what happened was it did break a high. They eventually broke back down below this structure, and it came back up. Right? Does that still count? Or does it have to be this exact pivot pattern? Right? And it could even be like you come up and then you come back and then it goes around like this for hours and hours and hours, and then it breaks the structure and comes back up and you take it, right? Yeah. What is the timeline? In other words, how much time can happen between these things in order for it to happen, in order for it to make sense, right? The line is the previous day's high. The line is the previous day's high, right? So kind of interesting. There's a couple of different ways that you can do it, right? You could come in and you could say, well, if this break of the structure doesn't happen within 30 minutes, then the trade is off, right? You could do that sort of a thing, right? Well, so here's what I did. I just said, let's start out with the most generous properties, right? We're only looking at these 3 points. When the high is broken, when the structure from before the high is broken, and when they come back to the any kind of fair value gap created between when the high was created and when the structure was broken. And those are the only qualifications for the trade. So they could happen like at any point in the day, right? And then we can set things up so that we can filter them even smaller and smaller and smaller, right? Okay, so that's what we did. So now we look at the code, okay? So first thing that we did is I filtered using, we're only interested in taking these trades if the open is in between the previous day's high and low, right? So if we opened below the previous day's high, okay, because it doesn't make sense. If we opened above the previous day's high, then does it comes back down and the break of the previous day's high, is that like really a setup? Kind of seemed like no, it was not. So I made the decision to filter based on that, and that helps the strategy backtest faster by a lot, because you know all of this code doesn't get run on certain days, right? Okay. So I did that. So here's one for when they're breaking the high, and here's one for breaking the low, right? Today's open has to be above the previous day's low. Okay. Another decision that I made was to only take it once. Okay. So that setup happens, because what could happen is that setup happens and then the trade fails and then you do it over and over and over again, sort of a thing, right? So I had it set up so that it only does it once. Okay. We could set it to like, so I'm actually looking at the execution in here. So I could say, you know, if you take an execution, then we'll reset it and everything. Okay. But what I found was that resulted in a lot of faults. Okay. So like the first time I did it, I didn't have that filter in there where it only does it once a day. And what ended up happening is it took the trade several times a day when that situation happened, and the win rate on it ended up being like 18%. Like it was a really terrible win rate. It was a really terrible win rate. So what does that tell you? When you get a price level that people think is important and they've moved around in that area, they're likely to continue just moving around in that area. Okay? You will see that a lot, right? Either there was a imbalance in the market orders that creates a trend, or it doesn't, then the market makers just chop it around in that area and it's just random. Okay. So that right there, I think, is a pretty effective, well, is a warning sign that the entire theory of this price action doesn't work. Okay, but let's continue. Okay, so then the next thing that we do is we are adding a couple of indicators here. So this is where I think that part of the reason why these price action strategies are so popular is because people don't know how to backtest them. If people knew how to backtest them, they would backtest them themselves and they would see that these strategies aren't very effective, right? But because it involves this whole pivot sort of a thing, it kind of turns into this amorphous thing that they don't know how to quantify, okay? But we do have a way of quantifying it, and in NinjaTrader, there's an indicator that comes by default. It's called zigzag. Now, you got to be careful with zigzag, because zigzag redraws on a chart, right? If it's moving like this, here's the zig, here's the zag, okay? And it comes up like this, it's gonna say there's a zag right here. But then it turns back down a little bit lower, and if it doesn't pull back enough, then it says, oh, that actually wasn't the zig, now the zig is down here. Okay, so it does redraw. So you can't rely on the zig just happened, okay? Keep that in mind, that's important, okay? But what you can do with a zig is you can come in and say, okay, we've moved from here to here. Here, let me redraw this. So we did this to this to this, right? Since we've already zigged over here, I can look at this one and I can say, where was this one? To find the structure, right? Okay, so that's what we're doing here, is we're saying, okay, so if we break above the prior day's high, right? I have the zigzag, prior day's open, high, low, close, current day open, high, low, so that I know what the open was. And then I have my fair value gap indicator on it, right? Okay, so if we break above the prior day high, then you can use this zigzag.lowbar. So what that does is it says, okay, what was the last? I'm looking for the first low within the look back period, which I have defined as an hour. Okay, so I look back for an hour for a low. If there was a low within the last hour, then I get a positive number in this last pivot. Okay, and then I can set some triggers. So I can say, okay, we have broken the high. The structure price is here, and the bar that we broke the high is here. And I save those things as instance variables up, you know, the instant variables that I created up at the top. Okay, right. Okay, so then it continues on. And then if we get below the structure high, then we'll trigger this one. So here we say, okay, if we've already broken the high today, and we move below that break high structure price, okay, and then there's a filter just to say, like, there has to be more than 3 bars on the chart, otherwise otherwise this indicator crashes, right? Okay. Oh my gosh, did we finish the playlist? Okay. So if those things fit, then what I want to do is I start looking for the gaps. Now here's a funny trick in NinjaTrader, okay? NinjaTrader does not actually run the indicator unless you're actually getting value out of it. So for this one, I just look at what the gaps at 0 is, just to force NinjaTrader to calculate the indicator. But then I have a method over here that gives me what was the last down gap that happened. How far back was it, right? Just whenever a down gap is found, it remembers what that bar is and it's returning that bar, okay? So, and then I use this zigzag to see what that last high from before this was, okay? So that means, right, we've broken below the price. Then I say, what was the high here? And where was the gap, right? And then I set all of my, right here is where I set all of my stuff. I say, okay, so the entry is the top of this, and the stop is this, and then based on the distance for the stop, here's what my target is. And I have an R factor so that you can say do 2 to 1 or 3 to 1. I think that 3 to 1 actually performed the best, right? And that's it. That's it. And then the next, this is just the same code, but for the lows, break of the lows. And then here is an on execution update so that, you know, when we've actually taken an when we've gotten filled, it sets this so that it doesn't try and do that again for each day, right? And then at the very beginning of the day, so bars since new trading day equals 0. So on the first bar of the trading day, I reset everything so that it can go again, right? That's the strategy, okay? With me so far? So I'm afraid to turn this one into an actual video because I'm worried that people would come in and be like, well, you should do it this way, you should do it this way, you should, you know. Everybody's going to want to try and do it a little bit slightly differently. But I think that if you take that code and if you wanted to adjust it to some sort of price action setup that you thought existed, you should be able to use those concepts to trade just about any price action strategy, right? As long as you can clearly define where that quote unquote support or resistance is, right? So then we go and we backtest it. Okay. And I think I can just pull up the one that I did yesterday to save us some time. Date here, gotta sort it by date. Oh, you know what I should do? I should, so now we got to come in here, find the strategy. Price action, high-low break. They're doing it on 3-minute bars. And we're going to go back to 2016 because that's a pretty good spot to start. The gap is only 1 point. Okay, so that's a big one that you can change in the look back. And I'm going to set the R factor to 3 so that we take 3 to 1. Oops. And we need to do it on the E-mini. I can put it in Discord. The code for the strategy. Okay, so here's the thing. Here's why I kind of said that I don't think that it would make a very good video. Over what is that? Almost 9 years. Thank you. If you recognize what that music is, you get a gold star. In 10 years, it only took 864 trades. So that's maybe a trade every other day. Okay. So just realize I would prefer to have more than 1,000 trades. Right? So already you should be kind of like, right? So probability is actually pretty good. 12.91 and 26.64. That's not bad. No, I have the include commissions on here. Did it not? Oh, you're right. It didn't do the commissions. Let's see here. Do I not have the commissions set, or did they get like changed? They must have gotten changed. So I need to come into accounts and edit account. Yep, it doesn't have the commission set. Correct. I'm doing it on this one too. Oh, maybe I'm supposed to do lifetime. Not direct, lifetime. There we go. Okay. We'll run that again. So you get the commissions. Now I'm pretty sure it's still profitable after commissions. Certainly takes a big chunk out of it though, doesn't it? Okay, so here's the thing. It is net profitable, but the stats are actually terrible. Yeah, it's not the worst outcome that you could get, that's for sure. Right. So a couple of things about this. Number one, The Sharpe ratio is 0.08. Okay, understand Sharpe ratio can kind of be gamed and it's not like the best measure, okay? But like you need your Sharpe ratio to be at least 0.5. Like get your Sharpe ratio to 0.5 and then you can start looking at some of these more advanced indications, right? Those more advanced indications are for strategies where they're able to get their Sharpe ratio into like 2s and 3s and stuff, right? The Sharpe ratio is awful. It's absolutely awful. The percent winnable profitable is also not very good. The exit criteria is either the close of the day or the target or the stop. It has a stop and a target, and that's it. So we could come in here to the trades, for instance, and we can sort it by exit name. You can see how many are exiting on the session, right? It looks like not very many of them actually exit on the session, so that's good, I guess. Then you got the stop losses, right? Oh, because the targets, yeah. So in the video, this guy did talking about the targets, but he was also saying, you know, you want to get like 2 to 3 risk reward, and I kind of felt that like taking a risk reward would be a better test of this, because you can then come in and set your targets and everything differently, but you can also come in here and like if you want to kind of analyze those sorts of things a little bit more, you can come and look at the MAE and MFE, right? So you can see that there's a bunch of these trades that just seem to stop out. You see this line right here? What that I think essentially says is that the difference between where your gap is and that high that you use for your stop, it matters, and the bigger that is, the more it can let the trade run, essentially. Are we going up or down? I think they might try and make another bull run here before, you know, stopping short of 4,000, but we'll see. So a lot of this is just the random, like the distribution that you would expect to see based on how big that target actually ends up being, right? There does seem to be this thing where, well, I don't know if it actually matters. I don't know if it actually matters, but there certainly seems to be like a maximum stop you could set that could probably help you out there, right? And maybe even a maximum target that you might be able to set, because you get the same sort of thing on the other side, right? There's ways to analyze that, but like the thing is, man, like look, the freaking Sharpe ratio is awful, and look at the analysis, or sorry, look at the cumulative net profit here. Okay, so look, this strategy did awful for the first, like, this whole market regime from 2017 until 2020. It was absolutely terrible, right? And then it had one time period, basically COVID, where it did well, which I think is a little questionable. That's the spot where those kinds of trades are areas where the backtester is more likely to fail you, right? And then this more recent behavior, like since the start of 2022, it's been pretty bad too. So what actually is it doing? It's taking on risk and it's using leverage. And there's not actually really an edge in it. On a risk-adjusted basis, there's not an edge to it, right? You would be better off just buying the E-mini and holding it. Taking one E-mini contract and hoping it works out would be a better trade. All right. Yeah, so you're right. ICT looks for like these areas where he believes that there will be lots of stops, right? But here's what I'm trying to say is that the way that price action strategies work, they put you into trades on, just on its own. They put you into trades in areas that will have a lot of chop. Like they're literally selecting for like the most random market movement. So this whole idea that like if it does this and this and this, and then that means it's more likely to move down with a certain probability and all of that sort of stuff is complete nonsense, because you're actually, all of the stats, all of the data that we get from backtesting it suggests that those areas are more random than your typical market. Trade management strategy. So I didn't add trade management to that, but you can do that. I have some strategies that do it. So sorry, if I come back here to this and you look at like net profit, right? You're gonna have some days that are really bad. So you can set a limit for how bad of a day before you stop. And that usually works out. So you believe in, so no. You believe in random walk theory? No. So a random walk, if random walk was true, you wouldn't see volume profile distributions, right? The distributions that you see in volume profiles or market profiles is a hint that the quote unquote random walk theory is false. Wow, is it an 11K? I can't see. Oh yeah, I see 15K traded at 39.75 because I have the ticks consolidated. Okay, so the thing that we know from market microstructure, Trading Bunny, and that we can prove is that if you sweep through an area very quickly, there's not very much time for the liquidity to recover. And so if you start, within 45 minutes or so, if you start retracing that area, you're likely to retrace through the whole area because of the lack of liquidity, right? It's going to be easier for them to retrace it, right? Basically, if you move up like this and it's really fast, there's going to be this whole area in here where the liquidity hasn't recovered. And after it's been yay long, then it's recovered. So like if it comes up here and then it's recovered, then when you come back into here, and it will be a little bit more standard, right? But if it does it before that, then they're probably going to come at least to here, right? And that's just like under normal market conditions, they'll retrace it, right? So you got to be careful, because that wouldn't be like, oh, okay, so then I should buy it right here, right? Well, not necessarily. Is there a meta order? Because if there's a meta order in the opposite direction, you're probably going to go even further, right? What does it mean when liquidity recovers? Okay, so like, let's just say that you are you're a person that uses limit orders. Maybe you're just the one limit order, right? But you come in here and you're like, okay, right now I think that I would be okay buying 114.30. And so you put your order in there, right? Okay. So then you put your order in, right? Now, as time goes on, more people are going to do that, right? Uzi's going to come in and put his in. Andre's going to come in and put his in, right? And so you get all of these orders that are out there, right? The longer that it's been since that price was traded, the more overall liquidity will be there willing to buy, essentially, right? So if we had just cleared through that area and you've created this whole area that we've swept through very quickly, then that whole area is not going to have a whole lot of liquidity providers in it. right? Which means that it's not going to take very much volume to push back, right? So this kind of a pattern that you might see where we're going like this and then whoop, and then it comes all the way back and it actually ends up going lower. This is caused by that phenomenon. Basically, this creates the liquidity hole. And so a meta order of equal and opposite size ends up pushing price more. In other words, this could be like 10K orders, and this could also be 10K orders. But we move further because the liquidity was damaged. That makes sense? Or I think it makes perfect sense. But did they answer the question? A meta order is not a block order. Okay, so the term block order kind of gets used for a bunch of different things, so I don't really like to use it. Okay. But a meta order is an order that cannot be executed all at once. So that is like, I need to buy or sell 10,000 contracts. It would be foolish of me to just come in and sweep 10,000 contracts. So you split it up. You split it up into smaller orders, sub orders, and execute it over time. That's what a meta order is, right? A block order, I think, would be best defined as a trade between two partners, that a large trade between two people that's agreed upon and then is later reported on the exchange in the block order book that you look at through the CME tools. That to me is what I put on the CME. That it's executed off exchange, but then reported to the exchange later, right? Some people will refer to these icebergs that we'll get as block orders as well, but I would prefer to just call it an iceberg. I think that's more accurate terminology, right? The whole topic of what words mean and where they come from, and like what would actually be an effective and not effective definition of is kind of an interesting thing to me, because you can call things whatever you want, right? But we kind of come into these places where what we call things could have some advantages or disadvantages, right? So I say that calling it a block order has a disadvantage because people could confuse it with other things. Whereas if I call it a meta order, it's very, very clear what that is. Knowing block orders is pointless because they don't. Well, I think that in the case of a block order, there really isn't a buy or a sell, right? Like in this market, you can say, is it a buy or a sell? What you really mean is, who is the aggressor, right? But with a block order, you had two parties that really made an agreement, right? What do microstructure papers called gaps? They don't define these gaps or look at them like that, right? They're so the way that the microstructure looks at it is, I forget the formula. Okay, but basically what we call it is lambda. Okay, so lambda basically is a measure of how much impact the orders have, right? So if we sweep through an area and then we come back down, what we're essentially saying is that lambda 1 is less than lambda 2. The lambda on this leg will have more impact because of the damaged liquidity, right? That's provable. That it creates these gaps and that sort of a thing. Well, look. When that happens on a chart, probably what you're going to see is something like this, right? Okay. But that doesn't mean that every time you see that pattern that's what's going on, right? You could only determine that from watching it on the DOM, right? You'll be able to see it on the DOM that like it went through and like, oh, there wasn't very, I'm always pointing it out, right? It's like, oh yeah, look, they swept right through that area and look, there was only like 100 contracts, right? And if that was an area that like, they hadn't traded, like they were down in here for a long time and then they just swept up through there and it only took 100 contracts each time to do it, then you've created one of those spots. And you'll notice that they tend to retrace very quickly usually. unless it's informed trading. Okay. Anyways, so I missed one thing that I was going to say about Uzi's thing, which is, so if a block order happened like that, again, a lot of volume trading in an individual place can also kind of create this situation, right? There's two ways that I've seen that tend to create this situation. One is slipping through an area very quickly. When you slip through an area very quickly, like, nobody wants to put their orders there, right? But then the other one is if it stays there for too long, then it also kind of creates that hole. And that hole actually kind of ends up why it stays there for so long. These are the spots that end up becoming the point of controls, right? It would be like this. Volume profile will look like that, right? Can be. It can be. Yeah, it's in some situations you could call it a mini flash crash, right? Or like, think of it this way on your chart. Right about here on March 10th, was it? Last Thursday? March 9th. I think that March 9th is a better place. From right here, like, the liquidity became damaged, right? And then what do you see after that? When there's less limit orders out on the exchange, massive volatility, right? Was there, so where was I getting at? Okay, so Jay also asked me, do you like market profile? So there is a reason why you get these kinds of distributions in the volume and market profile, but the reason why is because of the thing that I just told you. Okay, so a lot of the concepts that have been built up around market profile, like theories about why this happens, are just dead wrong. Especially these ones about value. So like, maybe one way of approaching this is that this market data that you're looking at, and there can be statistical aberrations in it, does not tell you anything about quote unquote value, or like what is fair value and not fair value, or anything of the sort. It tells you absolutely nothing. It's only telling you about what the liquidity conditions were compared to the market orders hitting into it. That's it. That's all it tells you. That's all you can really determine from that. Now, if you know what was going on, if you know what the news was, the things that were driving those particular orders on those days, and there can be things like news, there can be the options positionings, all sorts of stuff, right? Then you might be able to make those kinds of determinations. Okay, so if meta order's primary goal is to minimize market impact and achieve better execution prices, why would it sweep the price? Makes no sense. Okay, so one, you definitely don't just like straight up sweep the price, right? But what you will get is, okay, we're just ranging, it's quiet, and then you get this sort of a thing, right? Why would they do this? Why wouldn't they spread it out over a longer period of time, right? Good question. Because there's a certain point at which you push that the market maker becomes strained, right? The market maker doesn't want to put the liquidity out, and it kind of leads to this liquidity hole where the offers are too big over here and the bids are too big over here for it to come down, and it just kind of sits in that range, right? And you'll see this so much in the treasuries, right? The treasuries tend to move in gaps like this. It goes aside and then it moves in a gap like this. And if you miss this run, it's real quick, then it's over, right? Well, the reason why they do this, and it is intentional, is that more volume gets executed in here. even though it's an area where the liquidity is less, the resting liquidity is less, it stays there for so long that you actually end up executing more volume there, right? So what you do is you make the push, create the liquidity hole, and as soon as you see the liquidity hole, you dial all your algorithms back. You still buy, but you're just buying less, right? That's why you're going to see this thing where it's like, there's not very much on the bid there, but they'll take it up and then it'll come back down. And then when there's some on the bid, they'll take it up and they'll just do that for like 45 minutes, right? They get more executed in there. So by creating that liquidity hole, they actually improve their price. They actually reduce their market impact by increasing their market impact at the very beginning and then backing off. They reduce their overall market impact. Make sense? Because if you just kept it as like a slight imbalance the whole time, then you're just going to get this thing and it's going to go further. Kind of a clever little hack, isn't it? But once you understand that, all the patterns that you see make sense, right? It really explains why you see patterns and why following the patterns and trying to make trades off of the patterns doesn't result in profitability, right? Because the pattern is the result of a real market behavior, a strategy that large traders are using to reduce their market impact. But the pattern doesn't tell you anything about what happens next, right? Because if they're executing a meta order and right there they're done, then why is this one going to happen? Or this one going to happen? You don't know. The only way you know is if you know the size of the meta order, right? So seeing this one tells you absolutely nothing about the probability of this one happening, right? Unless, but where it ends up being useful, I shouldn't say unless, but where it ends up being useful is if you know why this one happened. I know why this happened, and I know that it's a big enough deal that that's probably only a third of the volume that actually has to trade, then I can pretty easily guess that it's going to do this. And I can guesstimate roundabout when it's going to happen too. It's going to be about 45 minutes from there, right? How do you know? So you have to know why they're buying it. Yeah, you have to know why they're buying it. So what are some reasons that they could be buying it? Well, so for instance, like yesterday, it was because they made the bank deal, right? So all of the banks were out there doing this. Come back and look at the chart of, I'll reduce this and bring up my ZN here. It's when I zoom it out that far, it kind of makes the chart. But do you see where it's like it comes down? There's a liquidity hole. Comes down. There's a liquidity hole. The other thing that you're going to notice is that each leg of this tends to start to be a little bit smaller because the impact, runs into that square root law. So you should see this curve. You should see this curve, right? So at this point, if we had been following the news, well, I mean, we had been following the news, but I don't think that I understood the headline very well when it came across. In fact, I think my news squawk was late on it. Okay. But if we had known, if at this point you knew, okay, the reason that this is happening is because of the banks, at that instant, this is what's going to happen. And especially if you can guess how many orders are going to be, but that right there, it will tell you that it's going to be a trend day. That's all you need, right? Now today we got another thing that can kind of help you here with this one. Although I don't, unfortunately, it's not one that would necessarily lead to an aggressive trend like this. Okay. But the one that you're going to see today is that we have options expiration, right? And there is a lot of supply at 4,000. So you were pretty well could have known that as soon as we hit 4,000 that you were going to start seeing meta orders starting to push the other way and pushing it down, right? And it's too late because they know. Okay, so there can be situations, yes, where as soon as the piece of information hits the market, like the move is done and over with and the trade is already passed. That can happen. But the sort of things that we're looking for are things that they have to trade for it. Okay. So like for this gamma, for instance, they keep themselves hedged, right? So anything above 4,000, they have to sell to hedge themselves, right? It's just like a mechanical thing. That's the way that their funds work, right? So even though we all know that it's going to happen, they're still going to do it in those instances, right? I think the best example is like when QE happens, right? So if the Federal Reserve is going to come in and they're going to buy a certain amount and they announce to everybody that they're going to buy the certain amount, right? It doesn't matter how much we, the market, pump it up before they do it. They're still going to buy it, right? So you basically you get a free front run card of sorts, right? Okay, but the understanding that most retail traders have that is wrong is that the market is perfectly efficient. There is all sorts of information out there, guys, that is not priced into the markets. And there are situations where you can predict that there are going to be meta orders coming and you can write in front of them. Okay. This is why I'm always saying you need to have an actual reason to trade. I need to have a piece of information that says to me there's going to be a meta order that's going to sell, right? There's going to be a meta order that's going to sell and I can front run it. And if I don't have a piece of information that gives me that sort of a setup, then I just sit here and yap, right? Are meta order execution strategies calculated to finish their order at a certain price? Like, are they starting the order at a value place and then calculating it to finish at another value? I would say not exactly. So when they execute a meta order like that, they're going to study the current market conditions and make an estimate for how much that's going to move the market. So they have, you know, like a benchmark, I would say, which is like on average, this is how we should perform. And if we're doing really good at our job, we'll actually get a price even better than that. Or if we just get lucky, we'll get a price even better than that, right? And that average price is what, if I'm going to execute for somebody else, is the price that I quote them. So they say, I need to buy 10,000. So then they come to the block trader, and the block trader says 10,000 would make this kind of impact on the market. And then we need to make a little bit of money. So this is the price that we can do that for. So then they make the deal. They say, okay, so we're going to do 10,000 at this price. And then they go out and execute it. And if they execute it well, then they should be able to get their average price to be below that level. Right? So you can kind of do that yourself here as well. So like something that's fun to do on Sim is just like, how many orders can I take, right? And you could say, if we're moving up, it's more fun. It's harder to do it on a trend. So you can say, okay, I need to buy 1,000 contracts and it's moving up. So how do I, you know, how do I do this so that by the end of the day, the VWAP ends up being above my price? Right, that's what you want. You want your average price to end up being below the VWAP for the day, right? But on another side is like, can you predict the exact price that the liquidity hole is going to form at if you knew the size of the meta order and everything? Kind of, but I think that there is a little bit of a random property as to where this particular phenomenon starts to happen. So from our perspective as retail traders, I think it makes more sense to not, you know, try and predict too far ahead, or make a deal of it until you actually see the indications that that zone is forming, that you start to see that the liquidity providers aren't putting very much liquidity up at any one time. It's coming, price is folding back on itself, right? So you get these bars that are kind of folding in on themselves, and you just get stuck in a range. Was there more absorption at 39.75, or are you talking about before the market opened when there was the big offer there? Oh, actually, it was a big bid, wasn't it? Is it in their advantage to initiate a meta order in an area likely to have thick liquidity? Generally speaking, I would say yes. So generally speaking, they would prefer to have a thick market to execute against, right? They don't like it when the market is light and your orders move things a lot, because that is what that essentially means, is that your costs for executing increase, and so your edge has to be that much more in order for the trade to be profitable, right? Because the thing that messes this all up is you take a trade and then you do this, right? If you immediately turn around and sell it, it's going to do this, right? So you need to have something that says that price is going to continue going up, and then you can sell it. But when you sell it, it's still going to do this, right? But hopefully, it's like been sitting there for a while. There's a bunch of liquidity, and so then when you sell, your impact is less, right? And then you make that, right? But there are some situations where if you are trying to take on a lot of risk, where it might make sense for you to do that. So for instance, if let's say, for instance, I'm a hedge fund, okay, and we just had this thing where the S&P 500 went up, right? And I say, that's bullshit. This isn't over yet. The S&P 500 is going to be down tomorrow. Yada, 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 blah, 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 right? Okay. And I want to be aggressive, right? Then it might make sense for me to hit against them and push price down like this, if for the only reason that everybody makes note of that push down, right? And it creates a temporary trend. So I can try to use my market impact to try and have a psychological impact on the market and reverse a trend, right? So there are some situations where you might want to make use of that thing. And one of the tricks that they can kind of do is you can buy like 5K and then sell like 10K, right? And if when you bought this 5K in here, if it starts, especially if it was into some key level that people thought was important or something, right? You can get people buying in and you can absorb. And then when you do this, it's going to move, right? And everybody makes note of that one, right? So this is kind of a trick that I'm aware of some market participants knowing about, that goes a little bit beyond the research, but that I've been told happens by reliable sources, let's say. That you can use the inverse sine law to take advantage. But it's just kind of funny because you can see it here. Like when I draw these pictures, right? You're all like, oh, but those are those price action setups, Seth. Yeah, they are those price. The patterns that they see, they are seeing a pattern. I don't think that you can be in the market for this long and not see the pattern. It's just the pattern doesn't tell you what's going to happen next. But sometimes it does this, and sometimes it does this. I make a lot more money on it doing this. I heard today that they extended the competitive bid close for the 4 and 8 week T-bill. Is that because of the bank issues going on? I don't know. I hadn't heard that, and I'm not 100% sure what would be the impact of that. So let's come back over here and look. Okay, so they do have a 4-week and bill at 9:30. Was that like maybe that was supposed to happen yesterday and they changed it to today or something like that? I don't know. That's interesting. It will be interesting to see what the market does at 9:30. If it ends up being a big deal or not. I need to blow my nose here. Kind of feeling gross. Does it? I have never heard of such a thing, Trading Bunny. I've never heard of such a thing before. So I'm going to say it's not common. It may, in fact, one might say it's even unprecedented. Well, so I take it that none of you want to, because I didn't get any requests to speak on Discord. I went through that whole thing and didn't get any requests to speak. That's okay. I mean, we've done this a few times and that was kind of what happened, but I thought maybe today it would be different. A lot of people join at the beginning, but then they're like, oh, it's just this. It's just that. You know, we don't care. I feel like there was something else we were supposed to cover in here, but that didn't turn into, I didn't want that to turn into a teaching market microstructure sort of a thing, but we did end up talking about a lot of stuff. But still, it's just like, I back tested it. So like, here's the thing. This guy said that strategy had an 80% win rate. And I'm like, well, there probably are some things that you could do to filter out some trades, but then you wouldn't get very many trades. So the reason why you think it's an 80% win rate is because you tested it over 1 week and it worked. And so then I tell you what, this is the crazy thing. Is he was like, you know, just go and back test it yourself and you'll see how it works, right? So then he made another video where he went through and he showed on the chart, here's the setup and here's where you would do it. And he did that over a week. And that's what he considered back testing. I'm glad you talk about microstructure because it's info. Yeah, it's not. It's not. But I mean, I think I can kind of understand why it's not, right? I think that there's a couple of reasons why you're not going to see it on there. The first thing is that it's based on very sophisticated research, right? To really learn and understand this stuff, you're reading heavy math books, peer-reviewed research. Most retail traders aren't going to do that. They go in, I used to think, oh yeah, people that trade and people that trade futures especially are going to be really sophisticated. Well, the people that do well, I think tend to be sophisticated. But I often find that there's a large portion of retail traders and futures traders that are not very sophisticated at all. The reason that they are getting into day trading is because they slacked off in school and they didn't start nice careers and they didn't get far on the other side, right? Like the really smart people that we tend to think would be futures traders are working for institutions. Those of us that end up being on the retail trader's side are the leftovers, right? All of us lowly dumbs, yeah. And I have no qualms identifying myself as that, right? I wanted to trade for the institution. I didn't realize it until it was way too late for me to go down that career track. I tried to just get myself into the institution through technology and then somehow switch over. And I discovered that basically you can't do that. Well, I mean, it's possible, but the way that things were set up and the way that things went at that time, it was never going to happen for me. That I knew too much about the systems from the technology side for them to ever trust any of the people on my team, even though we were all very. I mean, I think that my integrity is unmatched, but just because of what happened with the well, it was never going to happen. With the London well, it was never going to happen, right? So then I had to come and do it on my own. Okay, so here we're getting the Michigan sentiment. And it's 63.4 versus 67, and the 5-year inflation preliminary is 2.8 versus 2.9, and the 1-year inflation preliminary is 3.8 versus 4.1. Okay, so the 1-year inflation preliminary being 3.8 is good. That means treasuries can rally here. How much can they rally? How much was that move? So this is where reading the numbers kind of helps, right? So we're at negative 213. We're now 210. So 3K net buy. So now you can say, do I think that change is worth more than 3,000 net contracts? I'm not so sure. I think that one's worth 5,000 net contracts. So that means that they might break that 15 again, but your risk reward isn't very good on that one. So probably not going to take a trade on it. Only the competitive part of the auction was rescheduled. Non-competitive bids stand. It was an issue with PAAPS. It wasn't extended. Okay, so it was more of a technical issue, right? Anyways, so that's issue number 1 as to why you don't hear a lot about market microstructure. Issue number 2 is that because it is a sophisticated concept, it gets mistranslated to people. So like there are some people that when this research came out several years ago started talking about the market profile and volume profile. Like there was a webinar on futures.io. I don't know if I'd be able to find it again, but there was one from these guys that never heard of before or since that went into this research and talked about this and explained how, this kind of destroys a couple of the concepts that people were using for auction theory that you kind of need to get rid of and stuff, right? But like they know the research and they're trying to explain it to other people, and then other people will misunderstand it, and it's very easy through telephone with such a sophisticated concept for that to drift, to deviate from the research, right? I'm doing my best to try and keep things like very specific to like, here's what the research proved. Here's how you could potentially use that in your trading, and trying to be as narrow as I can about what was actually proven so that we don't get that telephone. But you know that it's going to happen. You know that it's going to happen, right? And then I think the final thing and the biggest one, though, is that it's not what people want to hear, right? So how does this actually happen in people's heads? Because this is what I see happen to people is they say, I'm one of those poor dumbs and I want to be something in life. So the way that I'm going to do that is by having success on the stock market. I'm going to become successful at the greatest game ever played, right? And so when I'm successful in the stock market, then that's my thing. So this is why you get so many finance bros where like finance is like their identity, or like Bitcoin, it's even worse, right? How many people are there out there that like they're into Bitcoin and they're going to hold it forever and that's their personality? Like you can't talk to them without them bringing up Bitcoin and them trying to convince you to buy Bitcoin, right? It's not just because it's a pump and dump scheme. It's because it has become such an integral part of their identity. And when you come in and you show somebody something that strikes at the heart of their identity as a person, you get very adverse reactions to it, okay? This is why, like, conversion therapy doesn't really work, right? Coming in and somebody says, my identity is, you know, that they're gay or whatever the deal is, and then you come in and you say, well, we're going to change that part of your identity. People don't like it. Like, that's the way that the human psyche is built, is to build an identity and be and hold to that identity very rigidly. And so people will react very negatively to attempts to try and change or redefine their identity, right? Which is kind of a funny thing, because like identity is something that has to be negotiated, right? Because your identity, what identity really is like, how do I present myself and what I am to other people, right? So what happens is, in the markets, is that somebody comes in and their identity is, there's a stock market guy, and they know everything about the stock market. So if you come in with a bunch of new research that basically says everything that you know about markets is wrong, they don't react very positively to it. And that's basically like everybody in the day trading space, right? So I'm literally coming in and telling everybody in the day trading space that everything that they know is wrong, right? And so even the people that come in here and have kind of been old hats, you'll notice that they're still kind of like, I don't know if they believe it, or it doesn't cause them to stop believing the things that they believed in before, and that sort of a thing, right? The people I find in chat that most understand and are like all in on the market microstructure concepts are people that were brand new, that I was like the first person that they came across, right? Because they hadn't already built it into their identity, right? And then I can come in and I can do this other thing for you, right? Which is to give you this advice. Don't make your performance your identity. There are very serious psychological problems with making your performance your identity, because once you stop performing, it strikes at the heart of your identity, and that will further impact your performance. So you have to disconnect yourself from your performance. Okay, your value as a person and your value to society is not dependent on how much money you're making in the stock market. It's not. Don't fall into that trap, because it actually can prevent you from getting good at this. Right? Because now you're in this spot where my identity is not how well I perform, right? How does Seth approach this, right? Seth's approach is not, his identity is not that he performs. His identity is that he relies on empirical evidence, right? Isn't that really at the heart of how I present all of this stuff to you guys, right? Is that the reason we're doing this is because this is what the empirical evidence suggests, right? So really what it comes down to is what is effective at finding what's effective, right? And I'm saying it's like the meta concept, right? What's effective at finding that? And I'm saying it's empirical research. You need to read other people's empirical research, and you need to have the skills to be able to do your own empirical research. That's why I show you guys like these back tests and all of these sorts of things, because the reason that so many people fall into these holes is because they don't have the ability to do that research. They have to rely on somebody else to tell it to them, and then all they can do is use these heuristics to be like, well, they were successful before, so maybe they'll be successful again, right? It's not a very effective way of doing that in the day trading space. That's the way that your brain tends to want to go, because it typically is effective in lots of things, but in a directly competitive space like this, it's not. And so instead you have to go to the data, right? You have to go to the data, and so I've presented it in that way, right? So now what I care about is researching what is effective, right? And how I know that I could be lucky, so whether I am successful with it or not doesn't really matter, as long as we're following the evidence, right? See what I've done? You're intentionally constructing an identity that is intended to help you perform and not dependent on the performance itself for the identity. Never be into sports. Well, so I think this would be like another thing, is like, yes, you can be into sports and being competitive. I mean, being competitive can be part of your identity. Absolutely, right? But you run into a problem when your identity is, I want to be an Olympian, and then you're not good enough to be an Olympian, right? So when you're looking at these jigsaw dumbs, do you actually understand? Of course. I mean, what you're looking at is not like the actual raw numbers is not that complicated, right? These are limit order buys, these are limit order sells, and these are market orders heading into that. If we tick up or down and then tick back, the center columns reset if it's been long enough. That's it. That's all it is, right? And everything else that we're talking about is just explaining why you see certain patterns happening, with the acknowledgement that those patterns do not necessarily predict the future. Or rather, they are not necessarily predictive of the future. You said break. When were you saying breakout? And yes, was that a little higher? Anyways, all of that spill was why don't you see other people on YouTube talk about this? Well, that's why, right? At some point, I think it will happen eventually. Probably not because of my efforts, but I would sure be grateful if I played a part in it. I think that at some point, market microstructure research will become a thing, and traders will learn about these things, and it will be a huge benefit to the retail trader community. Oh, that's what it was. So somebody was going to say, where was it? I can't find the exact comments, but somebody was saying, oh yeah, Mr. M, as soon as too many people research and talk about it, the market adapts quickly. Okay, so this is the brilliant thing about market microstructure, I think, is that it's not based on the behavior of people, right? It's based on the mathematical properties of the market, mathematical properties that are created by the very rules of the market. So this whole square root law kind of liquidity hole sort of a thing, it doesn't happen because people have a tendency to start behaving in a certain way and yada yada yada. It happens because like the literal setup causes that to happen. And then because of that statistical property of the market, that then creates certain optimal strategies. So optimal execution will always be a thing. Okay. Now, of course, it's always still competitive as well, right? Like those behaviors are going to be consistent, but if those behaviors create an actual inefficiency, there's definitely a race for people to get to that inefficiency first, right? So you can have a situation where the inefficiency always exists, but maybe you as a retail trader might not be competitive at getting it, right? But it'll always be there. And as such, it kind of becomes base, right? It sort of becomes something that at the very least you should be aware of. So I cannot make money just off of market impact itself, right? Like, even with the information that I have, if I started a big firm and I started executing for people, I probably would do okay. I could probably do better than what most people do, like what most people would do on their own. But I wouldn't be as good as like what Goldman Sachs or JP Morgan does when they execute, right? Strange to see volume drop after the open. But you know what though, I'm not really that surprised. Because my thinking going into today was they're going to have a really hard time getting above 4,000. There's probably going to be at least one attempt to try and push higher. But that at the end of the day, it's probably going to be a shit day because of the options expiration, right? The very fact that limits are cross-matched with market orders multiplied by price velocity, right? The very use of the limit order book causes these things to happen, or at least that's the theory. That's one that I think you could say is a little bit. Some people might have an argument against, but I believe the research very strongly suggests the best explanation here is that the very use of the limit order book causes these things to happen, because we see them in every market that uses a limit order book, even markets that we would think behave differently, but they don't, like Bitcoin. Even after a $54 million breakout. So there's two things that you got to remember here, right? And one is it's a big options expiration, but then the second one is there's a Federal Reserve meeting next week, right? So they did all of their big buying yesterday. Now you kind of get pinned when the options are the biggest thing that's going on. Like, we're not getting any big headlines today, right? So that's not doing anything. When the options come off, what tends to happen is the volatility tends to increase immediately afterwards, right? But next week, because we have a Fed meeting immediately after the options expiration, now you kind of get in this extra weird situation where you know, they're probably still going to hold things tight until Wednesday. So something you could see happen is the markets be really, really quiet until after the Federal Reserve. Maybe the Federal Reserve meeting goes well and it's like a buy. And then the next day after that, then everything becomes unleashed. And then if they're going to sell it down really hard again, then they'll actually do it then. Right. Like if I was somebody that wanted to go like a hedge fund that wanted to go short and I was looking for a tactical location to do it, I think that I would probably be looking to do it next Thursday morning. You see how I'm able to, like, I don't know how you explain that. Like if I was going to program that into something, I don't know how you do it, but I hope that you can see how it's like, okay, here's all the information that we have and here's how that leads us to this might be the best time to buy it, right? I could be wrong because maybe Wednesday just ends up being dismal, right? But I think that you're going to see the markets move a little bit more freely after next Wednesday. I have no clue what you're saying there, Kulud. Like my good friend Animal Mother said during the Vietnam War, you talk the talk, but do you walk the walk? Okay. I don't know what that means. I hope that's not another jab at you should be taking trades right now. I don't know, man. Yesterday, maybe it was just from arguing. Well, I did have a workout. I worked out on Wednesday, and I hit myself pretty hard. Like my traps were hurting, and traps are one that when you hit traps that can really smack you hard. So my nervous system might be recovering from that. And maybe that's why I felt kind of a little tired yesterday. But I just was like, I feel so burnt out, man. And it's like, I didn't really take, I mean, I took sim trades, but I didn't take any live trades because I knew how much it would burn, you know, how I've been through that before. I'm like, no, this is not the situation to trade. No, I've not seen Full Metal Jacket all the way through. I've only seen parts of that. I guess it's on the list, but when you have kids around, you have kids and your wife's not interested in those kinds of shows, you know, just kind of goes on a long list of things to watch. It's okay. You look okay. Well, I think I'm doing better this morning. A good night's rest really helps, right? I also, I don't know what it is, but like, because it used to be that I could argue with people on Reddit and go down like 10 replies deep and think it's funny. But these days I find it exhausting. Sometimes it's, people will say things and it kind of makes me feel angry. And I'm like, no, that's not right. I'm going to respond to like, I'm going to write the bestest response to this ever. But in the end, it's kind of exhausting, right? Especially when you can tell that it's upsetting them for some reason, right? Like in this instance yesterday, because it sounds like this guy has some money. It sounds like he was like making money managing some businesses and then turned around and started trading it. But he hasn't been trading long enough, in my opinion, to really be saying what he's saying, you know? And so it was back to that identity thing. His identity is, I'm rich and I'm so smart. I'm going to turn around and I'm going to show you all how smart I am. And then you're all going to make millions of dollars too. Right? And anything that kind of pokes is in contrary to that identity, they get super upset. They don't even know why it pisses them off, right? So if somebody was to come in here and give me a research paper, give me a link to arxiv.org that directly contradicted something that I was saying, I would be the happiest person in the world. It would make me so happy. I mean, I would be skeptical at first, right? And I would be like, well, okay, so let's quantify this, what we can actually prove from this, and does that actually match up with what you said? And, you know, we would do all that sort of a thing. But if we actually changed, you know, like the inelastic theory of markets really changed my view of markets, right? I think I was always kind of a person that did better when it was trending, but I so often found myself trying to trade against the trend is what it was. Because like I was looking for areas of absorption to rely upon, and when you do that, it always ends up with you trading against the trend, right? Once I understood that the markets are inelastic, because the reason that you do that trade, right? All trading really comes down to, do you go for the breakout or does it stay in the range? That's, you can bring everything down to that, right? Is it going to break out? And then if it does break out, which way, right? Once you understand how inelastic markets are, you kind of realize that, kind of makes more sense to go for the trend. Right? Just wait until the situation when you know it's going to trend and just take advantage of those, right? That completely changed my approach. And so then I just only traded the situations that I was good at. It made a big difference. It made a big difference. I loved that paper. I love that paper. I think that it's the most significant paper in terms of forwarding our knowledge of finance and economics of the last decade. Isn't that the oldest TA adage, just follow the trend? Well, I'm not. The thing is, I'm not following the trend. I'm predicting the trend, right? I want to be in before it's clear that there's a trend. But it is the oldest TA adage. It's true. I guess the other side of that is that a trend in price is not effective enough. But what I would call a trend in order flow is. So somebody earlier, I think it was Uzi, asked me, could you go deeper into auto-correlated order flow? So I can quantify it for you. There's an indicator in NinjaTrader called R squared. And R squared is basically a more statistical concept that basically is trying to quantify how predictive something is. So like if you're going into the backtester in the NinjaTrader backtester and it says R squared and the R squared is really high, that means that for the times that you were in the market, your strategy was extremely predictive of what the market was going to do during that time. Okay. So having a high R squared is good, but also kind of a warning sign because it shouldn't be able to get that high, right? So when you just run it on price, what it tells you is how predictive is the price of the future price, right? So I have R squared on a chart over here on the S&P 500. And so when it's above 0.75, that means that we're strongly autocorrelated. And when it's below 0.25 or so, it's very not autocorrelated at all. And so you see that, like, look here, we trended up pretty good. And then look at the indicator, right? Starts going up really high. And then, oh, we start ranging around in here. And so now the autocorrelation is low, right? So it's an indication of how trendy the market is, right? And you can take that indicator and run it on any other indicator to show you how autocorrelated that indicator is, right? So then you can come into like your cumulative delta and you can say how autocorrelated is your cumulative delta. So I don't have it on this chart, but you can see here during this period, we were pretty consistently going up. During this period, we were pretty consistently going down. And now over here in this area, it's kind of a little bit more all over the place, right? So in this area, the R squared would be relatively low. So what you do is you make a strategy that says when the autocorrelation of the order flow is relatively high, then I take a trade in the direction of the order flow. And that back tests really well. Wow, it just got a little bit of a surprise jump there. Hold on. Are we missing something? I think that it would be just so typical if there was something happening right now and I was not aware of it, because that's the way that it's been going all week, hasn't it? I mean, the S&P 500 is falling pretty hard here too. Yeah, ES did break the low. It was the low from before the open. Well, now you know you get to play all of the fun price action games, right? We broke the low, so now we get to see if it breaks the structure. Well, I guess in this instance that would be really hard, because in order to break the structure, quote unquote, depending on how you set your pivots up, you would either need to go back to the high of the day at 39.92 or 39.78. Either one, I think, would be a pretty tough, heavy lift. Pretty heavy lift. So maybe we won't get to go and psychoanalyze all that stuff. But I personally am concerned that there could be a headline lurking out there. So I'm thinking about this stage thing for Discord. And I'm thinking, you know what we need to do is we need to have a guest. Like it can't just be Seth starts the stream and it needs to be like we planned ahead of time for somebody else to also be on there. And the people can ask the questions or get involved in whatever kind of debate that they're having. I think that would probably work better, and because I really want to get more people involved, do better community building, you know what I mean? I just don't know how to do it. It's kind of frustrating. Was I actually talking about the top and bottom color syndrome? No, when we were talking about, you know, you're either the breakout or the range bound trade. There was some volume behind that in the treasury as well. About 9,000 contracts. This is well past the Michigan sentiment, although could be the Michigan sentiment kind of helping it.
Turkey's President Erdogan says that Turkey will ratify Finland's NATO membership.
Oh, Turkey says that they will ratify Finland's NATO membership. That, I think, is relatively significant news. What else can it do? Credit Suisse deposit run continues despite SNB rescue. Now it was about trying to count. Oh, right. Yeah. Yeah, because I think I paid too much attention to icebergs, right? I would be like, okay, I want to buy, and then I would wait for an iceberg buy to show up and try and join the iceberg. And then I would find myself constantly trading against the trend. I don't know. Early on, I did lots of things that were dumb, and I'm sure that even now that I'm making mistakes that are really silly. But you don't know what you don't know, and it's a really tough game. Not always going to work out for you, right? I mean, I suppose that on my part, one thing that I probably should do in some instances is be willing to put more risk on. You know, like I don't want to trade when I don't have an edge. But there are some situations where I do have an edge, but I'm still so cautious about it that I don't really trade as large as I should be. Yeah, it looks like they're going to continue up through here, man. There's got to be something going on. Let's pull up here real quick. The market's definitely getting hammered. So is Credit Suisse doing anything interesting right now? Well, it is slightly down on the day. I'm not so sure that can really explain it. There could be some other institution that's having a problem. What is it called? BKR? No, gosh, what is it? KRE, that's what we want. KRE doesn't look too hot. So, I think that we should just be aware that there could be under the cover news that we don't know about relating to a bank, right? It seems like there's a information network within the banking community and we're not a part of it, right? I want to see the Sachs getting bankrupt and trading it their own bankruptcy. Well, so in this particular, they always talk about how Goldman Sachs is always like right there in the midst of any kind of crisis. But as far as I can see, Goldman Sachs actually has like some of the lowest exposure to this sort of stuff, right? Like they were trying, like here's what happened was they were trying to get into the consumer banking sector. It didn't work very well, and they just like jettisoned the whole unit before all of this other crap happened. Right? If they were still like all in on that thing, and maybe then they would be under pressure, but just the algos and maybe. That volume that I'm seeing in the treasuries really looks like news to me. Like look at this. It's a more significant, like here was over here was the consumer sentiment, and then here's this random event, right? This is bigger than that. Something's happening here. There's got to be some news. It's just maybe sometimes there's news and we don't get it, you know? Like the whole thing, like yesterday, there's got to be some people that kind of knew there was something going on, right? And made money off of it. Off of that bank getting rescued. Meanwhile, yeah, because the news is like the best edge you can have, man. If there's something out there to know and not everybody knows it, I want to be the one that knows it. and we don't always find it for sure. But there have been times where we did find it, and it's been to our advantage. So I think it's always worth trying to find it. I don't know what to do in this situation, though. I mean, I think it's a little bit too late in the day for me to start taking trades on all of this, but... Now I see SVB filed for Chapter 11. So going back to this, Credit Suisse thing, what exactly happens if depositors really do just pull everything out? Does that mean like the money is gone and the Swiss National Bank that gave them the money takes a loss on that? Because it never gets paid back? What is that a problem? If the bank actually goes kaput? Like if you do a bailout and the bank still fails, what happens? Depends, of course. like, if the Federal Reserve bailed out AIG, for instance, and then AIG still went under, so number one is they could provide even more assistance. Okay, but in this particular case, like, why would anybody want to put their money in Credit Suisse? Why would you do it, right? If the brand is just so damaged at this point, right? There's nothing you can do. It's just going to go kaput. So every dollar that you put into trying to rescue it is just going to be lost. Nothing, be happy. I don't know, man. I think this stuff is going to continue they're just going to be fits and starts. They'll just keep going in fits and starts. And we might not be in the best position to know when those are happening, unfortunately. There are some things that I'm kind of good at. I'm good at keeping tabs on, and there's other things that I'm not. And what's going on the inside at the banking sector is, as I don't know. We need the network. We need to be calling people on the phone and being like, hey, you know, can you know anything about this? And then they'd be like, oh, yeah, you know, I don't, but my buddy, he might know. You should go call him. And then, you know, you need the boys net. I need the old boys network. Because it will get bailed out, so it's okay, don't worry. No, they already got bailed out. That's the problem. In order to fix this problem, you guys all need to go and put your money, like, in order for this to be fixed, that you NASDAQ Technologies need to go down to your local Credit Suisse branch and put your money there. That's the only way we can save this, is if people start depositing their money in the bank. Are you going to go and put your money in Credit Suisse right now? I think maybe not. The game is rigged. Wow. I don't know if I can say that it's rigged, because it probably just a coincidence that it turns out the way that it is, but there are definitely some certain advantages to certain people and disadvantages to other people. Yeah, they're continuing through, man. You tell me this is not news. There's no way, man. Insider trading, it could be. I mean, listen, just because they know about it and we don't know about it doesn't make it insider trading. But so what we should call it instead is informed trading. I think that this action strongly suggests informed trading. I could try going along with it. I'd say that usually works out, but I don't always get a very good price. You certainly wouldn't want to trade against it, though. You don't want to trade against informed trading, right? That's a surefire way to lose. Momo CTA is blowing up? Could be. You think that, like, they as soon as they got a little bit of a pullback, they bought so they could get out of their positions? I don't know. I would hope that most of the CTAs were long out of their positions by now. I mean, that's been all week that they've been sitting in pain, if that's what's going on, right? I never stretched. You guys need to remind me to stretch before the market open. Call them at the block trading desk and see. It could be right. So do you think that the momentum strategies would really be that far behind, or would take an excursion that far to try and get out? I mean, I don't really know. I guess this is what I'm saying. I'm searching for some sort of piece of information that would actually suggest that outcome, right? Something's definitely up, oh man. Okay. Let's see what Reuters is saying here. I just got linked to a Reuters story on Twitter. Investors are increasingly seeking insurance against a sudden crash in stocks, fearing that more turmoil is in store for markets after worries over the banking system shook asset prices over the last week. Various measures of perceived tail risk, the possibility of suffering large investment losses due to sudden or unforeseen events, have climbed to multi-month highs in recent days as concerns over contagion from the collapse of Silicon Valley Bank and instability at the European Bank Central Credit Suisse gripped markets. Nah, I don't think that that's it. In this particular instance, by the time you read, well, that's not true, Lucas. That's not true. Okay, so yesterday is a good example, right? So it was a big move. There was a big move. We were, by the time I had kind of realized what was going on, it was time to stop the stream. But guess what? That move went 4 times further than it did. Like, I had that short on and we're like, well, it's, you know, I actually think it is going to go lower in the end, but here is a stopping point and we got to go soon. So I took it off, but it did go further. It went 4 times further. Like, that would have been a $10,000 trade if I had kept it all on. Absolutely. It was an absolutely insane move. So even if you're late, you can make money on those, man. The right piece of news. And sometimes you can be early. This one we're not. You can't win them all. But I really think well, that one, I think that if you really understood the piece of news, you can know that you just go short the treasuries and hold it all day. Right? You can get pretty good at guesstimating how much a net change in cumulative delta is going to come through. Right. The reason why we have a hard time knowing how far it's going to go is because the liquidity conditions change. But you can get pretty good at predicting how much of a net change in cumulative delta there's going to be. No, you don't. No, that's not how you would do it. You would need to derive value of the market that the news know. What you would need to derive is how many orders would be triggered by that particular piece of news. Right. So for the piece of news yesterday, every bank was involved in that piece, that news, which means that you know that every bank is going to be out there executing on it after it's officially announced, right? That's a lot of volume that's going to come through. So using that information, you could have made a very, very good prediction that it was going to go all day. We're talking about the bailout of National whatever bank. First Republic, rather. I'm talking about when the news hit of an agreement to bail out First Republic Bank. That was one that if you read the news and you realize that like every major bank was in on that thing, that it was going to end up being a trend day. Because every desk that has their name on that, even if they don't know about the news beforehand, as soon as they see that, they're going to be like, oh, okay, so we're supposed to buy now, right? Y'all don't sing the Yanks. I know. I don't know what you're talking about. So why are the banks down today? I don't know. It's a good question. Is it just a pullback from yesterday, or is there another bank stressed? It seems to me like there could be another bank stressed. And that's why I was just saying, I don't see any direct evidence of this being related to Credit Suisse, so I'm not trying to say that it's Credit Suisse. But what I am saying is, does there come a point at which it's no longer practical to quote unquote bail out banks? Because I'm kind of starting to wonder if that can happen. Because they don't seem to be fixing any of the problems. Unless you're positioning yourself, you still have to deal with order flow and traders trading, or you read news, so what? Where are you getting in? What's your risk? Well, I don't, so this is a good question that I'm going to answer. I'm confused. I would think that you would know the answer to that, because we've been through this before. So I'm kind of confused at what it is that I'm supposed to say here that's like where the disconnect is coming from. So you do have to deal with other competing order flows, right? But there are some situations where you can kind of game that out and see what the net effect is going to be and pick the right side. There are other situations where there's a certain piece of information that is just so dominant that anything else that's going on at the time just doesn't matter. Yesterday was one of those times, right? Where do you get in? You want to get in as early as you can, right? And if you can't get in during the initial spark of it, then at the very least you want to get in on the most favorable side of whatever kind of liquidity hole forms. But yeah, like yesterday, I think that if you were on the ball, that you should have just hit market. Yeah. Doesn't matter what price it is, just hit market. Yep. So you just hit the market like blindfolded. So it sounds to me that like what concerns you is you don't care what price you're getting. Shouldn't it matter what price you're getting? No, it doesn't. It doesn't matter which price you're getting, really. If you know that the flow is going to be behind you. Why? Because markets are inelastic, right? We all want to attach this mystical property to the price that doesn't exist. They're getting in as early. Now you're just asking for toxic order flow. No, because if you really have an edge, let that, if you actually, so yesterday, here again, perfect example. Okay. I didn't know that it was going to happen. Okay. But I got in a trade. There was plenty of toxic order flow against me. Guess what? Worked to my advantage in the end, because the reality of the situation is that anybody that was trading against that piece of news was stupid. Well, maybe not necessarily stupid, but not informed, right? But nobody would have traded against that if they knew. No idiot would trade against that if they knew, right? You need to have an actual real edge, right? Like when I hear that, it's like, oh, okay, yeah, but then price moves around and all this. Yeah, that's why you don't trade those situations. You only trade the situation where the edge that you have is so strong that you'd have to be an idiot to trade against it if you knew the information. Okay, it matters what price you're getting if your books are marked based on that at the end of the day, but that doesn't apply to us, right? I 100% mark it in on my live account all the time, guys. Where you been? I guess you're not usually not watching when I do that, right? Because I'm kind of sneaky about it. But right, but it sounds to me like you're still trying to ascribe some sort of predictive or value-based value to the price that doesn't actually exist. You're trying to say, well, because of where the last pivot was and all of this sort of a thing, 16 makes sense to buy, but 20 doesn't. And I'm saying, if you have the orders behind you, doesn't matter. Okay, if you're in a liquidity hole, you can use the liquidity hole to your advantage, but otherwise it doesn't matter, because if I buy 19 and there's another 100,000 contracts to come behind me, it doesn't fucking matter which price I'm gonna get. I'm still gonna make money because that's 100 fucking contracts, right? Like, it's going to move. And yes, I'm using like pretty high profile piece of news to say that, but there are all sorts of smaller things that you can make the same part of play on. You can come in, and if you know that 10,000 contracts are going to come through, you know, and you're at the beginning of it, you're set, right? What matters is not the price that you get. What matters is how many orders are behind you. If you're too late in the trend and 8,000 have already gone off and there's only 2,000 left, then that's not very favorable to you, right? No, I'm gonna stick to the micros for a while. I think I want to just continue to build it up on the micros, move over to trading multiple contracts on the micros, and then eventually just move back to TN probably. I'm not convinced that ZT would be favorable ground for me, but maybe I'm wrong. Yeah, again, I'm only trading in a situation where you'd have to be an idiot to trade against it if you knew, right? Because if I just used a single contract on ZN/ZB, the risk parameters would be too high. I'm way more comfortable doing these micros. And now I could, to be honest with you, the account is large enough to trade multiple contracts with the micros, but I do not feel like I've accomplished what I want to do yet before I size up. But that's where I'd say, like, maybe I'm being too overly cautious in some of these instances. Certainly right now, I completely minimize my risk. But, you know, if we were in a tighter market, then I would probably start trading 2 to 5 contracts. Yeah, I could have plenty of room to be wrong for it. Hold it for an hour in the micro 10-year. Whereas if I did it, if I was doing it over here in the treasury, it's like if it even goes 4 ticks against me, I'm freaking out, right? So it makes much more sense with the size that I want to trade, right? If I had like 10,000, if I had 10K in the account, then maybe it would make sense for me to start doing the treasury, right? Well, okay, so you think, I understand why you think price matters to you, but what I have not seen, like here again, is some sort of empirical quantitative way of proving that this price is better than this price in this situation, right? Because what I'm saying is, if there's a meta order coming, they just hit it. These, like, it goes up 8 ticks, they don't fucking care, dude. They have to buy it no matter what. And they're more worried about getting as much in before it does that. That's all they care about, right? So how are you going to get this thing that's like, this particular price is more useful than this one, right? You think that it matters because that's what matters to your profit and loss, for sure. But that still doesn't mean that that particular price has any probability of being a good position compared to this price.
To 3.3 billion
right?
euros.
Unless
lowest level in 2020.
you know that there's a meta order and you get in earlier in the meta order, right? Yeah, it is. This is just like what I was saying, is that the people that are older, they'll never believe it. In the end, unless you started with a correct understanding of market, it becomes too big of a part of the way that you do things. So you want to think that the price that you picked it mattered and that you're good at picking the price. But again, can you prove it? Can you prove that that price in this situation is better than that price? Because there's ways to do that, right? We can backtest these things and everything. But I continue to go in here and like, okay, here's your price action setup that everybody talks about. Look, it's not very good. Why? What you're saying makes zero. So what you're doing again is you're falling for the same fallacy, right? How much money Seth makes from it, or how well Seth does from it, makes absolutely no difference to whether the empirical behavior of the market is true or not. Right? That's anecdotal. How well Seth does with it is anecdotal. Seth doesn't want to put a whole lot of risk on with it, so he doesn't. We are actually trading well. It's costs are really high for me, but we are trading well. You want me to turn around and make $1 million, and if I had made it, here's the thing, is that if I had made $10 million from trading, then you wouldn't question a single thing that I said, would any of you? Probably not. If I had a $10 million sitting in a bank that I didn't tell you about, none of you would question it. But you know what? You still wouldn't have learned a single fucking thing. right? Because the whole point is to look at the empirical evidence and make your decisions based on the empirical evidence. So, and as long as people aren't, if you're gonna say something that's like, okay, well, but what about this? Or what about this? Is the thing that you're saying empirical? Like, can you empirically prove that that matters or doesn't matter, or that that's more or less likely to happen in certain situations? Because if it doesn't, then why are you even bothering saying it to me? Because you know that I'm just going to ignore it, right? If there's not empirical evidence behind it, it's worthless. And you're wasting your time saying it to anybody. No. So if I traded ZN with an appropriate risk, the same kind of risk parameters that I do in the micro, it would be pretty similar performance. In fact, I think it would be better performance. Right. But I think that it would need to be like 50,000, like an account of 50,000, right? Because if I don't want to lose more than 1% in a day, right? Then that's only $500. No real news. Well, there is a real empirically proven edge from news that the news moves the markets. There is. Okay. And you're trying to say that like there's something else about the particular price that you get that matters, that it hasn't been proven. I think you're right. I want to have, well, no, I want to have like an 8 to 16 tick stop instead of a 4 tick stop. Yeah. I think that in most cases I can get away with 4 tick stops, but well, that's why price doesn't matter to you. Okay, but you're still haven't proven that price matters ever anyways, right? Like what or rather, I could say this, okay? Show me a back test where you're holding a 4 tick stop and it comes out profitable, right? Because I'm going to bet that when you do it in a situation like that, it's because you're catching a lot of momentum, and wherein the particular price that you don't care doesn't matter because it probably went further than when your target was anyways. Right? Like I could come in and do the back test. You can see what the MFE is, what the MAE is, and then you'd also need to track something else that NinjaTrader doesn't do, which is how much you could have gotten if you just had held it even more. And then you could quantify how good the price that you got actually was. And could you prove that the price that you got was actually better than random? Right? Listen, if you're not interested in talking about empirical data and proven things that we can prove will matter to your trading, go away. Because I don't want to talk about this other bullshit that you guys all seem to believe it matters, and there's absolutely zero proof. Time for me to go.